Good day, investors. In this video, we're going to take a closer look at FSKKR Capital stock, ticker symbol FSK. The stock price has been declining recently, and at first glance, it actually looks incredibly cheap. Right now, the stock is trading at about half of its net asset value, which immediately grabs the attention of value investors. But once you start digging deeper, the situation becomes a lot more complicated. The company's net asset value has been declining. Several loans inside the portfolio have stopped paying interest, and the dividend was recently cut. In fact, the company reported significant realized and unrealized portfolio losses in 2025, which pushed NAV lower on a per-share basis. At the same time, the entire private credit industry is starting to show signs of stress, with rising defaults and investors becoming increasingly cautious about the quality of loans inside these funds. So the key question becomes, is FSKKR Capital a deep value income opportunity, or is it a dividend trap? In this video, we're going to break down why the NAV has been declining, what's happening in the private credit market, whether the dividend is actually sustainable, and whether the stock might still be attractive at current prices. But before we get into it, remember to leave a like for the YouTube algorithm and subscribe to the channel for more upcoming videos. Thank you very much. So first, let's quickly go over what the company actually does. FSKKR Capital is what's called a business development company, or BDC. A BDC essentially functions as a lender to private companies. Instead of lending to large, publicly traded corporations, like traditional banks often do, FSKKR Capital mainly lends to middle-market companies, many of which are backed by private equity firms. These are often leveraged buyouts, where a private equity firm acquires a company and finances part of that acquisition with debt. And that's where FSKKR Capital comes in. They provide that debt financing. In return, the company earns interest income from those loans, which is the main driver of its earnings. Now, because BDCs operate under a special regulatory structure, they are required to distribute most of their income to shareholders. And that's why many BDCs offer very high dividend yields. At the moment, FSKKR Capital has an investment portfolio of roughly $13 billion, spread across more than 230 portfolio companies. Most of these investments are senior secured loans, which means they are backed by collateral and sit relatively high in the capital structure. So if a borrower runs into financial trouble, senior lenders like FSK are typically first in line to recover value. On paper, that should make the business model fairly defensive. But lately, the fundamentals of the portfolio have started to show signs of deterioration. So now let's talk about the most important issue with this stock. Why is the NAV actually declining? Net asset value, or NAV, represents the value of the company's investment portfolio after liabilities. For a BDC like FSKKR Capital, that essentially means the market value of the loans it holds. And if those loans lose value, NAV declines. Since early 2025, the company's NAV has fallen quite substantially, and there are three main reasons behind that. First, loan markdowns. Some of the loans in the portfolio are now worth less than they were previously valued at. This can happen when borrowers struggle financially or when market conditions deteriorate. In fact, during 2025, the company reported more than $2 per share in realized and unrealized losses, which significantly reduced NAV. Second, rising non-accrual loans. A non-accrual loan means the borrower has stopped paying interest. This hurts the company in two ways. It reduces income, and those loans are often written down in value, which pushes NAV lower. At the end of 2025, about 3.4% of the portfolio was on non-accrual, which signals increasing credit stress. And third, higher interest rates. Many of these companies were acquired during the low interest rate era, when debt was cheap. But now financing costs are much higher, which makes it harder for some borrowers to service their debt. As a result, lenders often mark down those loans even before a default occurs. So the key takeaway is this: the NAV decline is not mainly caused by the dividend. It's being driven by credit stress inside the loan portfolio. And that's exactly what investors are worried about right now. Now, to really understand what's happening with FSKKR Capital, we also need to look at the bigger picture, the private credit market. Because the issues affecting FSK are not happening in isolation. The entire private credit industry is starting to experience stress after years of rapid growth. Over the past decade, private credit has grown into a roughly $2 trillion market, with funds stepping in to lend to companies that banks no longer finance as aggressively. But recently, cracks have started to appear. One of the biggest warning signs is rising default rates. According to data from Fitch, the default rate among U.S. private credit borrowers reached a record 9.2% in 2025, up from 8.1% the year before. The main reason is the high interest rate environment. Most private credit loans are floating rate, which means borrowing costs increased dramatically when rates rose. And many middle-market companies simply weren't prepared for that level of interest expense. At the same time, investor sentiment toward private credit has also started to shift. Some funds have seen investors requesting withdrawals, and banks are becoming more cautious about lending to private credit vehicles. So the key takeaway is this: private credit is now going through its first real stress test after years of easy money. And lenders like FSK Capital are right in the middle of that cycle, which means the performance of this stock will likely depend heavily on how the private credit market evolves over the next few years. So now let's talk about the question many investors are probably asking. Is the FSK dividend actually sustainable? For most of 2024 and 2025, the company was paying a quarterly dividend of about 70 cents per share, consisting of a base dividend of 64 cents and a supplemental dividend of 6 cents. But the problem was that earnings were starting to decline, while the dividend stayed the same. Eventually, that gap became too large. As a result, the company recently cut the dividend by nearly 30%, lowering the base payout to 45 cents per share with an additional 3 cents supplemental dividend for a total of 48 cents per quarter starting in 2026. The reason for the cut was simple. The old dividend was becoming harder to support with actual earnings. When a lender like FSK starts experiencing loan markdowns, rising non-accruals, and lower net investment income, management usually has two options: either keep paying the dividend and weaken the balance sheet, or reset the payout to a more sustainable level. In this case, management chose to reset the dividend lower. Now at the new level, the payout is much closer to being covered by the company's earnings, so the dividend is probably safer today than it was before the cut. However, the key risk going forward is still the credit quality of the loan portfolio. If non-accrual loans continue to rise and credit losses increase, then earnings could fall further, and that could eventually pressure the dividend again. So the sustainability of the dividend really depends on how the private credit cycle evolves from here. So the final question becomes, is FSK Capital actually a buy right now? Well, the answer really depends on how you view the risks in the private credit market. On the positive side, the stock is trading at a very large discount to its net asset value. With the share price around roughly half of NAV, the market is clearly pricing in more credit losses ahead. If the credit cycle stabilizes and non-accrual loans stop rising, the stock could eventually re-rate closer to NAV, which would offer meaningful upside. And even after the recent dividend cut, the stock still offers a very high yield, which is attractive for income investors. But there are also clear risks. Credit quality in the portfolio has been deteriorating, troubled loans are increasing, and the company has already had to cut the dividend by nearly 30%. That means this is not a typical safe dividend stock. Instead, it's really a high-yield investment that depends heavily on the health of the private credit market. So my view is that FSK Capital is probably best suited for investors who understand the risks of the credit cycle, are comfortable with volatility, and are primarily focused on income. But for more conservative dividend investors, it may simply be too risky at the moment. And ultimately, the future performance of this stock will likely depend on whether the private credit market stabilizes or deteriorates further. If you found this video helpful, please leave a like for the YouTube algorithm and subscribe to the channel for more upcoming videos. And always remember to do your own due diligence before making any investment decisions. Thanks for watching and happy investing.